Welcome back, everybody, to another episode of Multifamily Report, Market News and Industry Insights. I'm your host, Travis Watts. What we're talking about here today is how the Fed's moves shape multifamily real estate. Disclaimers as always, never financial advice. I'm not a CPA, I'm not an attorney, I'm not a financial advisor. Please always seek licensed financial advice when it comes to your own investing. Now with that, I'm going to go ahead and dive right in. We're going to talk a little bit about the Federal Reserve and what led us to this point here in mid-2024. And I want to start by just further explaining what the expectation was before the Fed came in to aggressively raise rates. And as you can see here, the Fed's new dot plot, this is actually as of their meeting 12/15 of 2021. This was published by Bloomberg, and this was the forward-looking forecast for the FOMC members. And it was basically, yes, we anticipate raising rates over the next several years, but it's looking like maybe up to 2%, maybe 2.5% Fed funds rate level. Now, what happened in reality? Well, they went extremely aggressive, going in surplus of 5% over about a year and a half time frame. And so for a little bit of perspective, this was the most aggressive tightening cycle in decades. You can see here on Statista, these are past rate hike cycles, and right there highlighted in red is basically the most recent. So extremely aggressive, cut a lot of people off guard. I mean, what better data did you have to look at in December of 21 when you're buying real estate than what the Fed is actually saying they're probably going to do in the next few years? So with that said, what happened in the industry of commercial real estate, cap rates began to increase as interest rates began to increase. And you can see here to the right of this chart, this is CBRE data, by the way. The higher cap rates go, the lower valuations come down. So it's basically put commercial real estate in a really tricky and tight spot over the last year and a half. So where are we currently? Again, mid-year in 2024. Well, this was off the Wall Street Journal. Blackstone just made a $10 billion multifamily purchase, which for a lot of people has been interpreted as a bullish flag and signal for getting back into the market now that valuations have come down. So very positive news for things to turn around. And Jerome Powell, the head of the Federal Reserve, says that another rate hike is unlikely. Again, anything's possible, and nobody has a crystal ball, including myself, but they have held these rates steady since July of 2023. So that's nearly a year at this point. And the forward-looking expectations now are for rates to start coming down. How soon, how much, and for what reasons, we don't know, but the Fed's looking to get to about a 2% inflation rate. Speaking of inflation, as you probably know, in 2022, inflation peaked out and has been coming down in a very meaningful way ever since. We're not quite to the Fed's ultimate target, which would be a 2% inflation rate, but we are expected to come down continually and hopefully bottoming out around 2025. So let's talk about valuations in the commercial space. And the formula is really simple. If you want to find the approximate value of a commercial property, more specifically a multifamily apartment community, you can simply take the net operating income that the property produces and divide by the local cap rate in that particular market. Now, cap rates can be found for free online, just a simple web search, or through brokers, realtors, and through other national reporting services. So cap rates are what I referred to here on this slide just a couple minutes ago. And right now they've come up because of the high rates. They're anticipated to trickle back down in the coming years. But let me show you why that's important. Let's make it real here for a minute. So if this is just, for example purposes only, just a simple way to paint the picture. If you had a property that produced net operating income of $2 million per year, and the local cap rate was, let's say, 6% in today's environment right now, your value would be approximately $33,300,000. 333,000 and some change. Now, if we change these dynamics to increasing net operating income to 2.5 million and cap rates came back down, let's just say by 1 percentage point to 5% instead of 6, you can see that that has a drastic and meaningful change to the valuation. This is why so many operators are needing and wanting to hold on to the properties they have right now. You want to try to hold on for the next few years as markets stabilize and begin to improve, hopefully, of course. So let's talk about supply and demand. I thought this graph just had to be shown on this episode. Multifamily building permits have plunged nearly everywhere nationwide. Now, what this refers to is builders building new apartment communities across the nation. This is the percentage of how much they've fallen since the peak in 2021. Now, markets that we operate in would include Dallas, Atlanta, Tampa, Orlando, Fort Worth, Jacksonville, and Fort Lauderdale as far as this graph is concerned. So you can see in most of our markets, we're hovering around 40% down from the peak, and Fort Lauderdale a little bit less, and places like Jacksonville a little bit more. So why is that important to understand? Well, the first thing is that when you begin new construction on a large apartment community, it takes several years to build and to permit and to bring that to life and bring it to market. So a lot of the new inventory that we're seeing in 2024 actually began in 2021 and early 2022. But according to the National Multifamily Housing Council, we have a severe shortage of apartments nationwide. In fact, the US needs to build 4.3 million more apartments by 2035 to meet the demand for rental housing. And so again, back to this previous chart, builders are pulling out and not building at near the pace that they were in years prior as we have this severe shortage at hand. So where does that put us several years from now? Back to a supply-demand imbalance. So once again, that's one reason why the forecast is to trickle back down, is because demand is going to surge back into the market. At least that's the prediction. Another thing I like to think about and showcase is the gap between owning a single-family home and renting in 2024. And as you can see here, it's basically a pinnacle of unaffordable housing right now, which is forcing a lot of people to rent. And a lot of people are simply choosing to rent just based off the lifestyle and the flexibility that it has to offer. So we have one of the widest gaps on record in US history right now between home ownership and between renting. So there's still a very bullish case to be made for apartments and for renting. So to speak a little bit about market cycle, that's ultimately what we've been discussing on this episode, is when interest rates came up, valuations came down, and that was basically a market cycle shift. So where are we in the market cycle? Debatably in phase 4, aka recession. Now, not to be confused by an economic national recession. I'm not suggesting that the United States is in recession based off the metrics they use to measure that. What I'm saying is commercial real estate is in a recession, and that can be defined, as you see here in the fourth quadrant, as increasing vacancy and more completions coming to market. So how can we back that into some data? Well, we can pull some from CoStar here. You can see the dotted line going vertically. That was Q1 of this year in 24. So vacancy has spiked and is nearing a peak, at least according to their forecast. And new supply is the blue line. You can see how much new supply has been hitting the market over the last year to year and a half. So once again, that's what defines a recession in the commercial space. This is where we are. And you can see as we move forward here in this forecast provided by CoStar that the absorption rate eventually outpaces the new supply, which means there's more demand than units available in the coming years. So some key takeaways from this quick presentation. Rates have likely peaked. Again, no one has a crystal ball. Rates are projected to come down from here. Lower rates would equal higher valuations in the commercial real estate space. Multifamily fundamentals are strong and are projected to continue to improve. Commercial real estate is on sale right now due to these higher rates. You're listening to Multifamily Report, market news and industry insights. I'm Travis Watts. Appreciate your time today. If you have any questions, that's my cell phone and my email there on the left of the screen. Don't forget to like, share, and subscribe. Thanks so much for being here, and we'll see you in the next episode.